In 1881, the Ottoman Empire signed away its sovereignty, not on a battlefield, but in a bank. The Sublime Porte, ruler of lands stretching from the Balkans to Arabia, had borrowed too much from European creditors. When it could no longer pay, the creditors did not forgive. They did not forget, they took control. The Ottoman Public Debt Administration was established, a foreign institution staffed by Europeans, empowered to collect Ottoman taxes directly. The empire still had a sultan, it still had an army, but its finances belonged to Paris and London. Within 4 decades, the empire was gone. Today, the United States owes the world $34 trillion, and the world is beginning to ask a question it has never asked before. What happens when they stop lending and start selling? There is a room in the Federal Reserve Bank of New York where the fate of nations is recorded in spreadsheets. It is called the Treasury International Capital System, TIC for short. Every month, it tracks who holds American debt, which countries, which institutions, which shadows moving money across borders. The numbers tell a story most Americans never hear. As of late 2024, foreign entities hold approximately $7.9 trillion in US Treasury securities. That is not a loan from a single bank. It is a web, intricate, global, and disturbingly fragile. Japan sits at the top, over $1.1 trillion. For decades, Japan exported cars and electronics to American consumers, then recycled the dollars back into American bonds. It was an unspoken bargain. You buy our products, we buy your debt. China follows, approximately $770 billion, down from a peak of $1.3 trillion a decade ago. The decline has been slow, deliberate, and accelerating. Beijing does not announce its intentions. It simply acts. The United Kingdom holds over $720 billion. Much of this is not British money at all. London serves as a financial hub, a way station for capital flowing from the Middle East, Asia, and beyond. Then come the surprises. Belgium, a nation of 11 million people, holds over $300 billion in treasuries. The Cayman Islands, population 70,000, holds nearly $400 billion. Luxembourg, Ireland, the Channel Islands. These are not investors, they are custodians. The money belongs to sovereign wealth funds, hedge funds, family offices, and entities that prefer not to be named. The true ownership is hidden behind layers of financial architecture, designed for discretion. The unspoken bargain. Why do nations lend to America? It is not charity. It is not even trust in the traditional sense. It is a calculation, one that has made sense for decades but is now being revisited. For exporting nations, accumulating dollars is a byproduct of trade. When China sells goods to America, it receives dollars. Those dollars must go somewhere. Converting them all to yuan would strengthen China's currency and weaken its export competitiveness. So the dollars are parked in the deepest, most liquid market available, US Treasuries. For oil-producing nations, the calculation was simpler. Since the 1970s, petroleum has been priced in dollars. Saudi Arabia, Kuwait, the UAE, all accumulate vast dollar reserves simply by selling what lies beneath their sand. Those dollars too flow into American bonds. This system gave America an extraordinary privilege. It could borrow at low rates, run permanent deficits, and finance its military, its entitlements, its consumption, all on the world's tab. But privileges can be revoked. The fragility beneath. The danger is not that one creditor will sell. The danger is coordination, or even the appearance of it. Treasury markets function on confidence. Buyers purchase bonds because they believe other buyers will continue purchasing. The moment that belief wavers, the mathematics change. Foreign central banks do not hold treasuries for yield. A 3 or 4% return is meaningless to institutions managing hundreds of billions. They hold treasuries for safety, for liquidity, for the ability to convert to cash instantly in a crisis. But safety is a perception, and perceptions shift. When China reduces its holdings by $50 billion, it barely registers. When China, Japan, and Saudi Arabia reduce simultaneously, even modestly, the market notices. Yields rise, prices fall. Other holders, seeing the trend, reconsider their own positions. This is not conspiracy. It is rational behavior. No creditor wants to be last out the door. The web that holds American debt together is strong, until it isn't. The threads are made of trust, and trust once frayed does not repair easily. The question is no longer whether creditors are satisfied. The question is whether they are preparing to leave, and what signals to watch for when the exit begins. On July 21st, 1944, the British delegation at Bretton Woods fought a losing battle. John Maynard Keynes, the most famous economist alive, argued for a neutral international currency, something called the Bancor, that would belong to no single nation. He understood what was happening. The pound sterling, which had dominated global finance for over a century, was being replaced. The Americans refused. The dollar would be the new anchor. Sterling would become just another currency. Keynes returned to London defeated. Within 3 years, he was dead. Within 3 decades, sterling's role as a reserve currency was finished. But the death was not sudden. It followed a pattern, 3 phases that have repeated across history and are repeating now. Phase 1. Quiet diversification. The decline begins in silence. For sterling, Phase 1 started during World War I. Britain borrowed heavily to finance the war, depleting its gold reserves and accumulating debts to American banks. The pound remained dominant. Habit and infrastructure kept it central to global trade. But the foundations had cracked. Through the 1920s and 1930s, central banks quietly increased their dollar holdings. They did not announce a loss of faith. They simply hedged. Today, the dollar is experiencing the same quiet erosion. Foreign holdings of treasuries, as a share of total US debt, have declined from 34% in 2015 to below 24% today. Central banks are accumulating gold at the fastest pace in 60 years. No one declares the dollar dead. They simply buy a little less of it. Phase 2. Coordinated alternatives. The second phase is architectural. Nations begin building systems that bypass the incumbent currency. For sterling, this phase accelerated after World War II. Then, the dollar-based Bretton Woods system formalized what markets already knew. American goods, American loans, American military power all reinforced dollar dominance. Sterling was grandfathered into irrelevance. The Suez Crisis of 1956 delivered the killing blow. When Britain invaded Egypt to retake the canal, the United States threatened financial warfare. Washington would sell sterling, crash the currency, deny IMF support. Britain capitulated within days, forced to withdraw not by military defeat but by financial dependence. After Suez, no one doubted where power resided. Today, the architecture of alternatives is rising. China's CEPS payment system, bilateral currency swaps, BRICS discussions of a common settlement currency. The infrastructure for a post-dollar world is being built in plain sight. Phase 3. The cascade. The final phase is rapid and irreversible. For sterling, it came gradually through the 1960s. Devaluation in 1967, the end of the sterling area, the final abandonment of reserve status by the early 1970s. What had been the world's currency became a regional one. The cascade happens when diversification becomes flight, when hedging becomes selling, when the slow bleed becomes a hemorrhage. Phase 3 has not yet arrived for the dollar, but the distance between Phase 2 and Phase 3 is shorter than most believe. It does not require a declaration. It does not require coordination. It only requires a trigger, a moment when enough creditors, acting independently, reach the same conclusion at the same time. The architects of de-dollarization are already at work, and they are not waiting for permission. In February 2022, the West deployed a weapon it had never fully used before. Within days of Russian tanks crossing into Ukraine, the United States and its allies froze approximately $300 billion in Russian central bank reserves held in Western institutions. Russian banks were severed from SWIFT, the messaging system that enables international transfers. The message was clear. The dollar system is not neutral. It is an instrument of American power, deployable against anyone Washington designates an enemy. Moscow had anticipated this. For years it had reduced treasury holdings and accumulated gold, but the scale of the freeze shocked even the Kremlin. It shocked others too. In Beijing, in Riyadh, in New Delhi, and Brasilia, finance ministers asked the same question. If Russia's reserves can be frozen, can ours? The answer: reshape the world. China, the long game. China's de-dollarization strategy did not begin in 2022. It began decades ago, accelerating after the 2008 financial crisis exposed the fragility of dollar dependence. The Cross-Border Interbank Payment System, CIPS, launched in 2015. It is China's alternative to SWIFT, processing yuan transactions outside Western infrastructure. By 2024, over 1,400 financial institutions in 100 countries had connected. The Belt and Road Initiative serves a dual purpose: infrastructure investment and yuan internationalization. Nations that borrow from China increasingly repay in yuan. Trade along the New Silk Road settles in Chinese currency. China is not attacking the dollar directly. It is building a parallel system, patient, methodical, expanding node by node. Saudi Arabia. The petrodollar cracks. For 50 years, the petrodollar was the dollar's anchor. Oil priced in dollars meant global demand for dollars. Permanent, structural, non-negotiable. In March 2023, that anchor began to slip. Saudi Arabia announced it was open to settling oil trades in currencies other than the dollar. Negotiations with China for yuan-denominated sales advanced. The kingdom joined BRICS as a full member in 2024. Riyadh has not abandoned the dollar, but it is hedging. The same quiet diversification that precedes every currency transition. When the world's largest oil exporter signals flexibility, the signal travels far. The BRICS expansion. In August 2023, the BRICS summit in Johannesburg extended membership invitations to 6 new nations: Saudi Arabia, Iran, the UAE, Egypt, Ethiopia, and Argentina. The expanded bloc represents over 40% of global population and nearly 30% of global GDP. Its members control vast energy reserves, critical supply chains, and emerging consumer markets. The summit's communiqué spoke of alternative payment systems and reducing dollar dependency. No common currency emerged. The obstacles remain immense, but the intent was unmistakable. A parallel financial universe is forming. It is imperfect, fragmented, often contradictory, but it exists, and it is growing. The pattern empires do not fall because their enemies unite. They fall because their periphery finds alternatives. Rome did not collapse from barbarian invasion alone. It collapsed when provinces no longer needed Rome, when the benefits of empire no longer exceeded its costs. The dollar's dominance rests on the same calculation. As long as alternatives are inferior, creditors remain. When alternatives become adequate, they leave. The architects of de-dollarization are not building a perfect system. They are building a sufficient one, and sufficiency is all that collapse requires. On the evening of Saturday, October 6, 1979, Federal Reserve Chairman Paul Volcker held an emergency press conference. The setting was unusual. Saturday night, outside normal business hours, designed to make headlines before markets opened Monday. The message was stark. Inflation was destroying the dollar. Foreign creditors were losing faith. The treasury market was approaching crisis. Volcker announced a radical shift in monetary policy. The Fed would stop targeting interest rates and start targeting money supply directly. Rates would rise as high as necessary to restore confidence. They rose to 20%. The Saturday Night Massacre, as traders called it, plunged America into recession. Unemployment surged. Businesses collapsed. The pain was brutal, deliberate, and effective. But here is the part few remember. Volcker acted because foreign creditors were already selling. The dump had begun. The Fed's choice was not whether to cause pain, it was whether to control the pain or let it control them. The mechanics of selling. When a foreign central bank decides to reduce its treasury holdings, the process is invisible to ordinary citizens. There is no announcement, no press conference. Instructions flow from Beijing or Tokyo to custodians at the Federal Reserve Bank of New York. Sell orders enter the market through primary dealers, the handful of banks authorized to trade directly with the Fed. If the selling is gradual, the market absorbs it. Yields tick up slightly. Prices tick down. Nothing dramatic. But if multiple sellers act simultaneously, or if markets perceive coordination, the dynamic shifts. Every bond has a price and a yield that move inversely. When selling pressure mounts, prices fall and yields rise. Rising yields ripple through the entire financial system. Mortgage rates climb. Corporate borrowing costs spike. Stock valuations, built on assumptions of cheap money, crack. This is not theory. It is mechanics, as predictable as gravity. The difference between reduction and dumping. Charles de Gaulle understood the power of creditors. In the 1960s, the French president grew tired of American monetary dominance. The dollar was overvalued, backed by gold reserves that Washington was steadily depleting. De Gaulle saw the contradiction and exploited it. France began converting its dollar holdings to gold, demanding physical bullion from American vaults. Plane loads of gold flew from New York to Paris. Other nations followed. De Gaulle was not dumping. He was redeeming, exercising a contractual right under Bretton Woods. But the effect was the same. American gold reserves hemorrhaged. By 1971, Nixon had no choice but to close the gold window entirely. The lesson: creditors do not need to panic sell. Steady, methodical redemption is enough to break a system. The Fed's impossible choice. When foreign selling begins in earnest, the Federal Reserve faces two options. Option 1. Allow yields to rise. Accept the recession, the bankruptcies, the collapsing asset prices. Let the market clear, no matter the cost. Option 2. Intervene. The Fed can buy the treasuries that foreigners are selling, absorbing supply to suppress yields. This is monetization, printing money to finance the government. Monetization stops the immediate crisis, but it accelerates inflation. Creditors, seeing their dollars debased, sell faster. The Fed must buy more. The spiral tightens. Volcker chose option 1. Brutal discipline. The question is whether any modern Fed chairman would have the will or the political support to do the same. And what happens if they don't? On August 12, 1982, Mexico's finance minister made a phone call that changed the world. He informed the US Treasury that Mexico could not make its upcoming debt payments. The country was broke. Within weeks, Brazil, Argentina, Venezuela, and a dozen other nations followed. The Latin American debt crisis had begun, and it nearly took Wall Street with it. American banks held over $80 billion in Latin American loans. If those loans defaulted, the banks would collapse. The Fed intervened with emergency lending. The IMF imposed brutal austerity. The crisis was contained. Barely, but it revealed a truth that policymakers prefer to ignore. Debt crises follow a sequence. One domino falls, then another, then another. The sequence is predictable. The timing is not. The 7 dominoes. When foreign creditors begin dumping US treasuries, the dominoes will fall in order. Domino 1. Treasury yields spike. This is the trigger. As selling overwhelms buying, prices collapse and yields surge. A 10-year treasury yielding 4% might suddenly yield 6, then 8, then more. The risk-free benchmark becomes the source of risk itself. Domino 2. Mortgage and corporate rates explode. Every borrowing rate in America is anchored to treasuries. When yields spike, mortgage rates follow within days. A family approved for a loan on Monday cannot afford it by Friday. Corporate bonds, already stressed, become unpayable. Refinancing dries up. Domino 3. Stock market valuations collapse. Equity prices are built on discounted future earnings. When discount rates surge, valuations implode. The companies that seemed invincible, the trillion-dollar giants, shed market capitalization by the hundreds of billions. Wealth evaporates. Domino 4. Banking system stress. Banks hold treasuries as safe assets. When those assets lose value, balance sheets deteriorate. Depositors, sensing weakness, withdraw funds. Bank runs, once a relic of the 1930s, return. Domino 5. Pension and insurance fund insolvency. These institutions hold treasuries to match long-term liabilities. When bond prices collapse, their funding ratios crater. Pension systems that promised retirement security cannot deliver. Insurance companies face claims they cannot pay. Domino 6. Federal budget crisis. As yields rise, the cost of servicing existing debt explodes. A government already borrowing $2 trillion per year must borrow more. At higher rates, interest payments consume the budget. Deficits widen. The doom loop accelerates. Domino 7. Political instability and social fracture. Financial crises become political crises. Always. The Latin American debt crisis produced regime changes across a continent. Turkey's 2018 lira collapse triggered emergency decrees and authoritarian consolidation. When savings vanish and prices surge, citizens demand answers. And scapegoats. The speed of contagion. In 2018, Turkey demonstrated how fast the dominoes can fall. A currency crisis became a banking crisis within weeks. Inflation surged to 25%. Interest rates hit 24%. Companies with dollar-denominated debt defaulted in waves. The government declared emergency measures, restricted capital flows, and tightened authoritarian control. Turkey was not a global hegemon. It was a middle power, containable, peripheral. America is not peripheral. If the dominoes fall here, there is no firewall. The contagion does not stop at borders, because the dollar is already inside every border. The illusion of isolation. Americans believe they are protected. The oceans are wide, the military is strong. The dollar is dominant, but financial crises do not respect geography. They travel at the speed of wire transfers. They strike retirement accounts in Ohio and pension funds in California. They arrive not as foreign invaders, but as numbers on a screen. Numbers that suddenly mean something very different than they did the day before. The dominoes are already arranged. The question is only what tips the first one, and whether anyone will be prepared when it falls. Not every nation that faces a debt crisis is destroyed by it. Some emerge stronger, reformed, restructured, reborn. Others descend into cycles of collapse from which they never escape. The difference is not wealth. It is not geography. It is not even luck. The difference is timing, honesty, and the willingness to accept pain before pain becomes catastrophe. The Survivors' Germany, 1948. 3 years after total defeat, Germany was a wasteland. Cities were rubble. The currency was worthless. Cigarettes had become money. Then came the Währungsreform, the currency reform of June 1948. Overnight, the old Reichsmark was replaced by the Deutsche Mark. Savings were wiped out at a ratio of roughly 10 to 1. The pain was immediate and universal. But the new currency was credible. The new central bank was independent. Within a decade, Germany had achieved the Wirtschaftswunder, the economic miracle that made it Europe's industrial powerhouse. Germany survived because it accepted destruction and rebuilt from zero. South Korea, 1997. The Asian financial crisis struck Korea with devastating force. The won collapsed. Banks failed. The nation required a $58 billion IMF bailout, the largest in history at that time. The IMF imposed harsh conditions: corporate restructuring, bank closures, labor market reforms. The chaebol, the giant conglomerates that dominated the economy, were forced to consolidate, shed debt, and accept foreign investment. It was humiliating, it was painful, and it worked. Within 2 years, Korea was growing again. Within a decade, it had become a global leader in technology and manufacturing. The crisis became a catalyst for modernization. Iceland, 2008. When Lehman Brothers collapsed, Iceland's banking system followed within weeks. The 3 largest banks failed simultaneously, with combined debts exceeding 10 times the nation's GDP. Iceland did what conventional wisdom said was impossible. It let the banks fail. It imposed capital controls. It prosecuted bankers. It refused to bail out foreign creditors. The pain was severe. The krona lost half its value. Inflation surged. But by 2012, Iceland was recovering, faster than Ireland, faster than Greece, faster than nations that had followed orthodox prescriptions. Iceland survived because it prioritized citizens over creditors. The casualties: Argentina, 2001. The Corralito trapped savings. The peso collapsed. 5 presidents in 2 weeks. Supermarkets looted. The middle class destroyed. But Argentina's tragedy was not the crisis itself. It was the repetition. Default in 1890, default in 1982, default in 2001, default again in 2014, and restructuring negotiations continuing into the 2020s. Argentina has resources, education, fertile land. What it lacks is institutional credibility. Each crisis is met with the same responses: money printing, populist spending, eventual collapse. The cycle never breaks. Greece, 2010s. Greece's debt crisis became a sovereignty crisis. Unable to devalue its currency and trapped inside the euro, it accepted Troika supervision. The EU, the ECB, the IMF. Austerity was imposed from outside. Pensions were slashed. Youth unemployment exceeded 50%. Greece survived, technically. But a generation was lost. The brightest emigrated. The economy shrank by 25%. Recovery, if it can be called that, took a decade. Lebanon, 2020. When Lebanon's banking system collapsed, there was no IMF rescue, no European backstop, no recovery plan. The currency lost 98% of its value. Banks simply refused withdrawals. A massive explosion devastated Beirut's port, and the government could not even clear the rubble. Lebanon became a failed state not through war, but through financial disintegration, the determining factors. The survivors shared three traits. They acted early, they accepted pain honestly, and they had institutional capacity to rebuild. The casualties shared three failures: denial until denial was impossible, political systems captured by elites, and external constraints that remove policy options. America has the institutions to survive. The question is whether it has the political will, and whether that will arrives before the choice is made for it. History does not repeat, but it offers templates. When great powers face unsustainable debt, they do not simply continue until the numbers become infinite. Something gives. The question is what and when and how much destruction accompanies the adjustment. For America, three paths remain open. Each has precedent. Each has consequences. And the window to choose is closing. Future 1. Managed decline. Britain, after 1945, chose retreat. The empire was unsustainable. The debts were unpayable. The military commitments exceeded national capacity. Rather than fight to maintain global dominance, British leaders reluctantly, painfully, accepted diminished status. India was released. Bases were closed. The sterling area dissolved. Britain became a European power, dependent on American protection, integrated into continental structures it had once held at arm's length. It was humiliating, but it was managed. There was no hyperinflation, no revolution, no societal collapse. Institutions survived. Democracy endured. The transition from hegemon to middle power occurred across decades, not days. For America, managed decline would mean reduced military commitments, renegotiated entitlements, fiscal consolidation, and acceptance that the era of unlimited borrowing has ended. It would require political courage that has not been visible in a generation. It would require telling voters the truth, that promises made cannot all be kept, and that adjustment now prevents catastrophe later. The probability of this path being chosen voluntarily is low, but it remains possible, if barely. Future 2. Inflationary default. Weimar Germany did not formally default. It printed. The government, burdened by reparations and unable to raise taxes, simply created marks. The currency became worthless. Prices doubled every few days. A wheelbarrow of cash could not buy bread. This is the soft default, honoring debts in nominal terms while destroying their real value. Creditors receive their dollars. Those dollars buy nothing. For America, this path would mean Federal Reserve monetization without limit, deficits financed by money creation. Inflation not as accident but as policy, the deliberate erosion of debt through currency debasement. The consequences would be severe: savings destroyed, fixed incomes annihilated, social trust shattered. The political backlash that follows hyperinflation has never, in any nation, been moderate. Weimar's inflation ended in 1923. Within a decade, Germany had chosen a different path, one that led to catastrophe beyond imagination. Inflationary default does not solve problems. It transforms economic crisis into political crisis, and political crises, once ignited, burn in directions no one can predict. Future 3, systemic collapse. The Soviet Union did not decline. It shattered. 1 year, it was a superpower, nuclear armed, globally present, ideologically confident. The next year, it did not exist. 15 republics emerged from the wreckage. The economy contracted by 40%. Life expectancy collapsed. Oligarchs seized state assets. A generation was lost. Soviet collapse was not merely economic, it was systemic. The simultaneous failure of political legitimacy, institutional capacity, and social cohesion. For America, systemic collapse would mean not just fiscal crisis, but political fracture. States defying federal authority, institutions losing legitimacy, social fabric tearing along lines already visible, urban and rural, red and blue, credentialed and forgotten. This is the darkest path. It is also at present the path America most closely resembles. The narrowing window 3 futures. One will arrive. The choice is not whether adjustment comes, it always does. The choice is whether adjustment is chosen or imposed, gradual or sudden, survivable or catastrophic. The window for choosing is measured in years, not decades, and the clock is running. In the final decades of the Roman Empire, the legions stopped receiving their pay in silver. The denarius, once nearly pure, had been debased for generations. Emperors shaving metal, stretching coins, funding armies with illusions. By the late 3rd century, soldiers demanded payment in goods, grain, cloth, land. The currency that had built the greatest empire in history was no longer trusted by the men who defended it. When soldiers stopped believing in money, they stopped believing in the state that issues it. The Western Empire did not fall to a single invasion. It fell because the center could no longer pay. Tax revenues declined as provinces were lost or devastated. Military payrolls could not be met. Soldiers deserted, switched allegiance, or simply walked away. In 476, when the Germanic chieftain Odoacer deposed the last emperor, it was almost an afterthought. The power had drained away long before the title was surrendered. Rome's collapse was, at its core, a fiscal event. An empire that could not fund itself could not defend itself, and an empire that could not defend itself ceased to exist. The pattern that never breaks. Across centuries, across continents, the pattern holds. Spain borrowed until its creditors demanded control. The Dutch borrowed until their capital fled to rivals. Britain borrowed until Suez revealed its dependence. The Soviets spent until the system shattered. Each empire believed it was different. Each believed its currency was special, its institutions unique, its power permanent. Each was wrong. The United States has now traveled far along this road. The debt exceeds $34 trillion. Interest payments consume more than defense spending. Foreign creditors are quietly reducing exposure. Central banks are hoarding gold. Alternative payment systems are being built. None of this is secret. None of it is speculative. It is visible in the data, audible in the policy debates, palpable in the actions of nations preparing for a world that no longer revolves around the dollar. The gathering storm is not approaching. It has arrived. The only question is when the rain begins. What is already lost? There is a cost to debt that does not appear on balance sheets. It is the cost of options foreclosed, of futures mortgaged, of flexibility surrendered. A nation drowning in debt cannot respond to crisis. When the next pandemic arrives, when the next war erupts, when the next financial shock strikes, where will the resources come from? The coffers are already empty. The creditors are already restless. The printing press is already running. America once had the capacity to remake the world. The Marshall Plan rebuilt Europe. The space program reached the moon. The interstate highway system connected a continent. What could be built today? What investments in infrastructure, education, technology in the future are foregone because every available dollar services the past? This is the silent theft of debt. It steals from those who cannot protest because they have not yet been born. The Ottoman Echo. In 1881, the Ottoman Empire surrendered its fiscal sovereignty to foreign creditors. The empire endured another 4 decades, diminished, humiliated, increasingly hollow. When World War I came, the Ottomans chose the losing side. By 1922, the empire was gone, dissolved into a republic that explicitly rejected the debts and obligations of its predecessor. The Ottomans did not collapse because they were weak. They collapsed because they had already signed away the resources needed to remain strong. The creditors came first, the citizens came last, and when crisis arrived, there was nothing left to defend. Today, America has not formally surrendered fiscal control, but the constraints are tightening. Every policy decision is shadowed by the bond market. Every crisis response is limited by debt capacity. Every future is mortgaged to service the past. Sovereignty is not binary. It erodes. And erosion, once advanced, is difficult to reverse. The final question. The world is not waiting for American permission to change. The dollarization is not a theory. It is a process, underway, accelerating, building momentum, with each sanction imposed, each deficit widened, each signal that the rules of the system serve only those who wrote them. The creditors of the world. In Tokyo and Beijing, in Riyadh and Frankfurt, in the sovereign wealth funds and central banks, and shadowed accounts that hold America's promises, are watching. They are calculating. They are positioning. They remember what Americans have forgotten, that empires end, that currencies fail, that the bills always come due. The storm clouds have gathered. The pressure is building. The first drops have already fallen. When the world starts dumping US debt, not in theory, but in practice, not gradually but all at once, the consequences will not be confined to trading floors and treasury auctions. They will arrive in every household, every retirement account, every assumption about security and stability that Americans take for granted. The question is not whether this moment will come. The question is whether anyone will be ready when it does, and whether, when historians write about this era, they will say the warnings were ignored, or that they were never heard at all.